Hello everyone, and welcome to Geopolitical Trends, where truth matters. It all started with China dumping US treasuries. You remember? A telltale story about the true economic conditions in the United States. In this video, I'm going to provide you my brief analysis about why the US is in recession, despite what the government is trying to hide this truth. Navigating economic turbulence, the recent US stock market plunge and its implications. Because that's what just happened this morning. The US stock market experienced a significant downturn on Monday this morning, reflecting a broader global sell-off aimed at rising fears of a potential US recession. The Dow Jones Industrial Average plunged by about 1,072 points or 2.7% soon after the market opened, while the S&P 500 and Nasdaq composites also saw substantial declines, although the market managed to pare some of their losses by mid-morning. The economic landscape remains fraught with uncertainty. Now, the immediate impact on the US market. Well, the Dow Jones fell by 1,072 points, marking a 2.7% drop, while the S&P 500 and Nasdaq composite also experienced similar decline, about 4.1% and 6.3% respectively. Major technology stocks were particularly hard hit, with Nvidia, Apple, Broadcom, Supermicro Computer, and Tesla all recording significant losses. So this market behavior echoes historical patterns such as the Dow's 2,997 point plunge during the early days of COVID-19, you all remember, and the infamous Black Monday, a crash which happened in 1987. What about the global market reaction? Well, the turmoil was not confined just to the United States. International markets also reacted sharply. For example, Japan's Nikkei 225 index dropped by about 12%, marking the worst rout in its history, and the Topix index fell by about 12.2%. I believe these drops reflect the interconnected nature of global financial market and the widespread impact of economic uncertainties emanating from the US failed economic and foreign policies. That's my opinion. Additionally, yields on the US government bonds hit multi-month lows, with the 10-year note at 3.6% and the 2-year note at 3.69%. What are the factors contributing to this sell-off? Well, several factors have contributed to the current market instability, and I'm gonna share 3 with you. 1, weak job reports. The US Department of Labor reported an increase in non-farm payrolls by 114,000, coupled with a rise in the unemployment rate to 4.3%. These figures fell short of expectations, raising concerns about the health of the labor market. Yet, our esteemed government has been lying all along. Number 2, shrinking manufacturing activity. A decline in manufacturing activity within the world's largest economy has added to the gloomy outlook. It's a reality, exacerbating fears of a broader economic slowdown. Yet, we want to sanction China? Yeah, good luck with that. Number 3, tech sector. The tech sector struggles. This was a dismissal forecast from top US technology companies, including significant stock drops for major players like Nvidia and Apple, have further dampened investors' sentiments. This last point specifically reflect China's rapid technological advances, which are, by the way, playing a leading role in contemporary geopolitical competition. Yet, we all here is that the US and its allies are concerned about how China may deploy technology in ways that challenges many of the US core interests and values. Really? I say to the US, let's compete with the Chinese. Simple as that. The fact of the matter is that the collective West is unable to compete with China. Herein the fact, China has made enormous investments and implemented policies that have contributed significantly to its economic growth, technological advances, and of course military capability. In some areas, China has eclipsed or is on the verge of eclipsing the US, particularly in the rapid deployments of certain technologies. I'll ask you, what have we invested in? I'll let you think about that. The role of the Federal Reserve, which needs to be abolished, by the way. The Federal Reserve actions and the future plans are critical in shaping market expectations. Analysts are the Goldman Sachs and JP Morgan have differing views on the likelihood of the US recession, with the Goldman Sachs estimating a 25% chance and JP Morgan assigning a 50% probability. The Fed's potential policy responses, such as rate cuts, are closely watched by the market. Chicago Fed President Austin Goolsbee suggested that the Fed would react to signs of economic weakness, indicating a willingness to adjust interest rate if necessary. We are already there. What the heck are they talking about? We are already in recession. Economist Michael Feroli has predicted a basis point cut at the September meeting, followed by another 50 basis point cut in November. Such actions aim to calm market nerves and stimulate economic activity, although some like Sam Strove from the CFRA research caution that aggressive cuts could signal panic and exacerbate investor tension. We shall see. Here is the historical context and the comparison you need to know. Comparing current market behavior to historical events provide us valuable insights. The recent declines, while significant, are not unprecedented. The Dow drops during COVID-19 pandemic and the 1987 crash serves as a reminder of the market volatility and resilience. We shall see. Understanding these patterns help investors contextualize current events and anticipate potential future trends. What about the economic outlook and implications? Well, the ongoing market volatility raises important questions about the broader economic outlook. Yet, most Americans are oblivious to this reality. Wake up, people! Should the US enter a recession, the impact will be far-reaching, affecting not only domestic markets, but also the global economy. This is the harsh reality. The interconnectedness of modern financial systems, that means that stocks in one region can quickly propagate, leading to cascading effect, if I may use the term. Now you know why most countries are de-dollarizing faster and faster. Here in my conclusion for you, I like to keep this brief and concise. The recent stock market sell-off underscores the fragility of the current economic landscape. Multiple factors, including weak labor market data, declining manufacturing activity, and tech sector struggles, have contributed to the heightened market volatility. The Federal Reserve's policy decisions will play a crucial role in shaping future market trends, with potential rate cuts aimed at stabilizing the economy. Good luck. As investors navigate these turbulent times, understanding the interplay between economic indicators and market behavior is essential. While historical comparisons offer valuable insights, the unique challenges of the present moment requires careful analysis and strategic planning. The road ahead may be uncertain, but informed decisions making can help mitigate risks and capitalize on opportunities in an ever-evolving economic environment. Please hit the like button and don't forget to subscribe. As always, remember, geopolitics impact your daily life in more ways than one. Till next time. Thank you.